Hello, trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at the stock and gold fallout after the most recent inflation reading here in the U.S. as we've got traders flocking to U.S. dollars once again. We'll cover the inflation part of it and the U.S. dollar part of it and the implications on potential rate cuts to come. But want to start out with the price action in the S&P and gold markets. S&P falling on today's session $50 from its highs, which you might say in the grand scheme of things, this rally in the year so far from 4,700 to 5,200, $50 isn't that much to write home about. But I think there is considerable fear in what this most recent inflation data could portend for interest rate cuts and the stock market at large if it is not just a one-off item, but a potential trend through the rest of 2024 as higher inflation, this time on the producer side, which we'll go in depth on in a second, is looking to potentially delay interest rate cuts in 2024. And we'll take a look at those odds for interest rate cuts in 2024 in a second as well. But what this means for stocks is, well, you have a stock market that had a really bullish rally at the end of 2023. And as you can see, a really bullish start to 24. And while a ton of this is on AI and strong earnings from a number of big market cap stocks that make up a big portion of the S&P, a portion of this at least is from the priced in effect of potential expansionary Fed policy vis-a-vis central bank rate cuts. And if inflation data is going to continue to outperform, be higher than expected, then Fed Chair Powell is going to be less inclined to commit those rate cuts, which he has not yet. We have not seen a rate cut yet, have not entered this expansionary Fed policy, as it's only been hikes since 2022, and we've stayed atop 5%. And so big implications for the S&P if right now, obviously, it looks like a blip. It's one inflation measure. But if inflation continues to stay high and we continue to get through March and May and June in terms of FOMC meetings without rate cuts, you might see this stock market price out some of the upside that they saw at the end of 23 and the first few months of this year with rate cuts being priced in. But let's take a look at gold as well, because this market, especially in the last 2 weeks, has seen significant upside, going from the 2,000 to 2,100 range to just blowing out 2,100 and nearing 2,200 in recent trade, but now falling back, as we can see, closer to 2,150, which in the grand scheme of things is still really high gold prices, but falling almost $20 from those highs on this higher inflation number. And then you start to bake in the idea of, okay, well, high inflation and higher interest rates for longer, what could that mean for gold? And the negative historic correlation between interest rates and gold, very apparent when you think about gold being a non-interest bearing asset and how demand might lighten up if interest rates are one, high, or two, staying high for longer because inflation is not moving as low as the central bank wants. Then gold might move off of its highs here, close to 2,200 for the time being. Again, just a short-term move lower, what looks like a dip in the grand scheme of things, but we'll see where more data goes here in the U.S. moving forward. Do want to bring the U.S. dollar piece into this in just a second, because you'll see how that pairs with this stock and gold data. They've been pretty stark inverses as well. But first, let's take a look at the inflation data that came out. PPI not been the highest priority data point in the U.S. in recent months, and for good reason, right? It's been right around 1%. And if you know about central banks and inflation, you know that major central banks like the Fed, they target a 2% inflation rate year over year. And the ones that they've been working to get down are more on the consumer side. CPI inflation, for example, in the last couple of years has been as high as 8% and beyond. PCE inflation, another measure, has been as high as 5-6% and beyond. The producer side of things, as you can see, has not been that much higher in recent history than that 2% target. So not much to worry about, right? Well, out of nowhere, it's 0.5% higher than expected, and the highest since September of last year. And one of the last things that those looking for rate cuts from the Fed would want to see is now, okay, they're getting CPI and PCE inflation rates close to 2%, and now this one is going to spike out of nowhere. That could cause a further delay in rate cuts coming from the Fed, and we'll look at how long they might get delayed in just a second. But let's rope in that U.S. dollar piece, and you can see across the board of major pairs, dollar higher after this higher than expected inflation rate. And I mean, big moves in Aussie, lower by more than 0.5%. Euro seeing a big move lower as well, getting below 109, and that Aussie getting below 66 cents. These are levels that these major currencies had just eclipsed against U.S. dollar, and people were maybe thinking, oh, now the U.S. dollar is finally going to take a break from its bullish few years. Well, Aussie hasn't been able to get much further than 65 or 66 cents, and the euro hasn't been able to break out much further than 109 or 110 in recent years. And so now the question becomes, are those markets moving down to their lows? Are we going to see another all-out U.S. dollar resurgence? Only time will tell. We've got March FOMC, we've got more inflation data coming, and more employment data coming for the U.S., as well as you got to think about if Australian data or Euro area data, Japanese data, UK data, if they dip and the U.S. stays strong, that part of it could continue this U.S. dollar trend. And of course, vice versa. If they see strength, they would potentially battle back against this U.S. dollar. But for time being, man, you can't find a major pair on the board where U.S. dollar is losing after this higher than expected inflation. Finally, let's conclude with the current projections for the May and June Fed meetings. May down to 4% chance of a rate cut, and this was as high as 20%, and even higher in recent months. Now down to 4%, getting pretty close to no chance of a cut in May. Of course, all these things, there's a lot of time between now and May, but it's moved lower in recent weeks, and now 4% is pretty close to a rounding error off of zero. We'll see if it fluctuates from there. But I think a lot of people getting worried about the June meeting, and you might say, well, Frank, it's still 63% in June. Well, this was 75% a month ago. And if it gets closer and closer to 50-50, we might have the same problem as the May meeting, where we're a month or two out and now it's flipped. Of course, once again, so much time between now and June, so much inflation data and employment data to say the contrary. But for the time being, you have rate cut probabilities trending lower. Stocks and gold starting to see a little bit of reversal from those highs, and U.S. dollar resurging after this hotter than expected inflation. We'll look to more data points coming in the near future to see if these trends continue or if they're just short-term one-offs off of this PPI here in March. More to come. Thanks for watching.